today. For the beginning, it would be great if everyone just gives kind of a short introduction of his allocation, how he kind of sees the equity markets right now. I would start on the left top from my screen. It's Uli. You've the honor to kick off. What's your? We already talked before we started the roundtable about the global equity markets. How are you positioned? How are you kind of adapted your portfolio through this Corona time?
First of all, going into the crisis, we were pretty much very on the defensive side. Not that we knew that the coronavirus was coming along, but because of valuations. We had been in a more defensive stance for all the different risk classes we cover. We had a high emphasis on balance sheet, on quality. That is family office style, if you want so, because our clients normally can get along very well with a few percent performance, but the major risk for us is losing. So we try to avoid that at any time. We were too cowardly not to buy into the dip, which didn't really last that long, if you see. The question really is, how real is it? Speaking of federal banks and governments, I think they're building a bridge there. And if you think that we have 40 million people in the US with the first unemployment claims and about 10 million people in Germany in fall-off. So the question is, the question now really comes to the point, what is going on going forward? I think you have to adapt, look at stable businesses, good balance sheets, things people need and use, and we see a divergence there to stable companies and tech companies, definitely, because the way we conduct business and do it here changes. We're more mobile, more on tech. So I think there are chances in this crisis, and you have to adopt it.
Thomas, you've been position neutral right now on your equity exposure, but you've been more defensive earlier this year. Maybe give us an insight how you adapted your portfolio and why you are still neutral and not like overweighting the equity exposure.
We went into the year with a huge overweight in equities coming out of the last year. We were pretty aggressive in the last year, which was good, which was okay, helped us. Okay, but I mean, during the coronavirus crisis, of course, to be that much overweighted isn't the best idea. So we decided very fast to go into a neutral position, and also shortly after that, we decided to go into an underweight position with a lot of hedging, and we were very defensive. Which helped us in the last weeks. And then we started buying again, coming back to the market. So right now we are in a neutral position, but we wouldn't change that. We think markets are pretty expensive right now. A lot of positive things are priced in already. We don't think it's a good time to be that much aggressive or much more aggressive. In the long-term view, yes, we are pretty constructive when it comes to equities. But in our more technical point of view, in the short term, we would wait until there's another dip, and then we would maybe go into an overall situation in our multi-asset portfolios.
Michael, you mentioned before that roundtable, as we talked, that you have to kind of hack the volatility. That is a perfect chance for active management, for stock picking. So in which sectors, where do you find those companies? You have to pick, as Raj mentioned, that they are like lesser companies with proper growth.
Yeah, this kind of stock picking we delegated to active managers who really did a good job during the downturn, also the rebound now. Of course, also with a large weighting in US tech, including the FANG plus stocks. We also increased our weighting in the Nasdaq 100 at the mid of February without any influence of Corona, a long planned move. Overall, we entered the year 2020 with a quite constructive view on equities, so that means a neutral weighting in equities. We reduced it around 20% to the end of February, and invested half of that again at the beginning of April. So we're a little bit underweight right now.
Well, actually, first of all, we came out of 2019 with a quite decent equity quarter and a kind of constructive stance to the market. And we had a nice year 2019. Well, like so many others as well, but it was quite good. And therefore, we kept this momentum. And then during the course of January and February, we also reduced our equity quota, as well as we did a sector rotation because of valuation reasons. It was already said. We had the same impression that the markets were running hot, and therefore we reduced the quota, and the sector rotation was done to go more in healthcare and overweight IT, and to reduce energy as well as consumer discretionary positions. In general, as a company, we expect a U-shaped recovery for the economy. It will be a bumpy road ahead, a road which offers a lot of opportunities. And therefore, we are moderately positive for equities, especially, like you said, US equities. The metrics for the US markets is just better than for the European markets in general, in our opinion. Therefore, we have a slight overweight there. And yeah, but you have to play the markets as they come, and you have to be quite active in the sector rotation as well as in changing your quota, and that's mainly our approach for that.
Raj, you're a global investor. Of course, there are, as you already mentioned in the introduction, alternatives to the FANG titles globally seen. But of course, we have to talk about the FANG titles. What's your kind of view on those big stocks in the US market? Would you say those are the definitely biggest winner globally seen, or is there also some, or should you be more cautious maybe on those highly concentrated FANG titles in the index?
I would start by saying that all indexes are based on past success. So whenever you look at any index, it's all about who's done best in the last 5-10 years. And sometimes that can still be coincident with future success. But by definition, as an active investor, I don't think that's always the case. And the FANGs are a great example of that, because clearly, if you look at the profits and the cash generation of these stocks, they have been the biggest drivers of cash flow and CapEx growth in the US and indeed globally as well. However, now looking at the future, I'd say there's a really big difference between some of those business models. If you look at companies like Amazon or Mercado Libre, the example I just gave, you know, my mother, who's in her 80s, is now discovering the joys of pressing a few keys on the keyboard and something magically arrives on her doorstep the next day. She loves it. She would never even have tried it before. So people who would never have adopted these ways of living, these ways of buying or transacting, are adopting them now, and they're not going to go back. So I think within that tech space that we think of as the FANGs Plus, there is actually a real divergence of the long-term prospects. And I think it's important to go back to basics on each stock, because there will be very big divergences in returns over the next 3 years.